Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Dennis wants to know, and I know you're the expert on this for sure. He wants to know about looking at the smaller currencies. I don't know if you watch the Iraqi dinar or the Korean won or the Vietnam currency, but the dong. Do you look at those, and which ones? I know you actually have recommendations on some of the other smaller ones, correct?
We do. We don't watch the Iraqi currencies or the Korean currency because they're not really tradable from a retail standpoint. We do watch the South Korean currency, the won, and we watch the Eastern Central European currencies, Turkish lira, South African rand, Polish, things like that, Mexican peso that are more tradable.
Right.
And they tend to move as a block. And it's a good question because in risk appetite environments, when we see a rally in the Aussie, really driven a lot by commodities, most of the emerging market currencies have commodities as their driver too. So if you're in a risk appetite environment that you think is going to carry, you can generally throw a dart at the emerging or exotic market currencies and do pretty well.
Right.
Because it's surprising how they move in a block. Same token, because the emerging market currencies tend to move faster on the upside, faster on the downside. If you're looking for a lot of action and you think you can really define these environments, you can get a whole lot of juice there.
Right.
And in fact, we've written about this a lot. We think the South African rand right now is without a doubt the most overvalued currency in the world, given the political risk and the danger in their economy. But it's appreciated dramatically in this risk appetite environment that we've seen when the Aussie has gone up. So this is one we're watching. And again, if you trade those currencies, you can get a whole lot, but be very, very careful because the spreads are wide, the liquidity is low.
Right.
You have to trade them with very low leverage, and don't trade them as much. Look for a longer-term trend train. That's what we look at. So if you want to trade those, remember, you're going to have to take on a lot more risk than the major currencies.
That's a great point about leverage. Obviously, leverage is a double-edged sword, and you got to watch out. Trading leverage in the euro is going to be much different than trading in the smaller currencies. So that's an excellent point. Simon has a question. Given the carry trade is weaker as interest differentials are less, how does this affect the yen vis-a-vis risk?
We believed that it was going to. We thought the lights were going to go out on the yen with a perfect storm in the economy. We thought that most all of the international investors were out of that carry trade, and we don't see the carry trade back in vogue. Those of you who are familiar with carry trade, it means you just borrow a low-yielding currency to invest in risky assets. In an ongoing environment where we're still seeing deleveraging on the private sector, and we're seeing a sentiment shift on just taking on new debt, we don't think we're going to get back in one of those leveraged carry trade environments. Because of that, we thought the yen was really going to get whacked. But I think what we've underestimated here on the yen is the fact that there's a lot of money still offshore, institutional investors in Japan, insurance companies, pension funds, domestic retail investors in Japan have a lot of savings that probably has still been offshore, and the money is moving back into the yen, even though the economy is absolutely falling off the cliff. Sooner or later, we think it will be lights out for the yen, as we said, once we start evaluating these currencies more on the underlying fundamentals in the economy, because Japan is in terrible shape. Of the three major, I guess you could say, regions, Japan, Europe, and the U.S., Japan economy is in much worse shape.
Right. Wow. E.L. has a question, and I think this is more for me, Jack. He says, if I believe a strong move is expected, but I'm not sure if I'm bullish or bearish, isn't a long-term straddle a valid strategy? And yes, the answer is, of course, you can buy, and let me take you back to that. Let's just say that we weren't really sure. We're taking a look at, let's just say, the euro, and we're trading at 72, and you thought you were going to have a huge move. Well, what could you do? Well, what you could do, let me just erase some of these things because otherwise it'll be confusing. what you could do is buy a straddle. Now, in every options trade, just like in any kind of investment, you need to understand your risk. So if you bought the call and the put, well, you could say, well, that's great because one of these is going to be worth something. That's probably true. But you got to remember, you're paying $6.35 to control the dollar against the euro. So at expiration, you needed to get below 66 or above 78 to make any money. So you basically, you needed to come down here or to move up into this range before you start making any money. So any of this area here, you would not be making money. So yes, you can do it, but you got to understand your risk, and you probably need to manage your risk a lot better because you're doubling your premiums. So I hope that helps. Let's take a couple more questions, Jack. Joseph wants to know, with the Chinese economy moving its account into 3-year notes, do you think they're trying to get the U.S. to raise interest rates or debase the dollar? What do you think?
It's always tough to figure out what the Chinese want to do. They float a lot of stuff out there for different reasons. In general, China probably would like the U.S. currency to go down from an export standpoint. Obviously, they hold the bonds, but in general right here, the driver for China is they have to get their export economy moving again. And they happen to believe that a lower Chinese yuan, which is pegged to the dollar, which means a lower dollar, will help them do that. So we think that view of a lower dollar, even though they complain about the dollar being too low, is ultimately meets their current strategy and their current domestic investment strategy of increasing infrastructure. But we happen to believe in a world in which the U.S. consumer has completely dropped out of the game, it doesn't really matter how low your currency value is. If they're not buying, they're not buying. If they're afraid to buy, lower price isn't necessarily going to help. So it's always tough to figure out what China's going on. We get a real kick out of the fact that China scolds the U.S. for its overconsumption. Really quite funny because of the fact that overconsumption is what has enriched China tremendously. So if they don't like that, then let's just let this world rebalance, and if our government would just get out of the way and let the world rebalance, we'd rebalance their overproduction to our overconsumption. And guess who would get hurt a lot more, again, if our government got out of the way and stopped trying to stimulate everything? China would be hurt a lot more. So you always have to figure out, what China really wants with the stuff they're floating, and it's not an easy chore at times.
So, Jack, you don't think that there's a lot of elasticity to price here with the as far as the U.S. dollar is concerned? You don't think if it weakens, it's really going to matter much as far as our spending habits one way or another, or even when we strengthened, we were able to buy more stuff, but we probably didn't, right?
No, we didn't. No, I don't. I don't think there's much at all in these, changing currency values. I don't think it's going to matter when you have global demand off the table. And you can even see that more in a microcosm domestically. The government has been, as one gentleman put out, I saw Nick had said, the Fed's doling out U.S. dollars like popcorn at a movie theater. Which is a great line, and it's exactly right. And we've seen them dump it out into the U.S. domestic economy, but the U.S. consumer hasn't rebounded. So in effect, the governments give us much cheaper, a whole lot of liquidity out here, but the U.S. consumer isn't taking it, and it's the same thing you can transfer globally in currency rates. When people are afraid, they're just not going to buy.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.